At Insightful Value, we don't chase hype. We dig deep to find companies quietly trading below their worth. And Olin Corporation is a name that keeps popping up. With its stock price hovering near multi-year lows, is the market sleeping on this chemical and ammunition giant? Let's take a closer look. This review is for informational and educational purposes only. It's not financial advice. If you appreciate these no-fluff breakdowns, make sure to like the video and subscribe to the channel so you never miss an update. Olin Corporation is one of the largest producers of chlor-alkali products and epoxy resins in the world. It's also a leading U.S. supplier of ammunition through its Winchester division. In other words, it operates in two major segments: chemicals, which are deeply tied to industrial production, and ammunition, which sees cyclical and sometimes political demand shifts. This dual structure gives Olin a unique position, not just industrial, not just defense-related. The company's stock has been under pressure over the past year, even though its business fundamentals are not collapsing. Olin reported revenues of around $7.3 billion in 2023, down from pandemic-era highs when demand for chemicals and ammunition spiked. Its operating margin sits around 12%, which is healthy but reflects margin compression from higher input costs and lower demand in some end markets. The recent earnings report highlighted softness in epoxy and vinyls demand, but management remains focused on disciplined capital allocation and cost control. From a value perspective, the company currently trades at a price-to-earnings ratio significantly below historical averages. That suggests the market is pricing in a long-term slowdown or some form of structural decline, but is that justified? Olin has been aggressively buying back shares and reducing debt, a strong signal that it believes in its future cash flows. Its return on equity has stayed in the double digits, and its balance sheet is relatively strong compared to peers. Let's talk dividends. Olin pays a modest but steady dividend, currently yielding just under 2%. While it's not a high-yield play, the dividend has been growing gradually and looks well covered by earnings. The company's real shareholder return comes from its repurchase program, which has been very active in recent years. This combo of buybacks and dividends reflects a value-focused capital return strategy. So, what's the risk? First, chemical businesses are highly cyclical. A prolonged industrial slowdown would pressure margins and earnings. Second, environmental regulations, especially around chlorinated chemicals, can create unexpected costs or even force structural changes. Third, the ammunition business, while profitable, is subject to political pressure and fluctuating consumer demand. And fourth, Olin's exposure to global markets makes it sensitive to shifts in commodity prices and international demand cycles. So why consider Olin now? The stock is priced for weakness, yet the company continues to generate solid free cash flow, buy back shares, and maintain a strong operational base. It's not glamorous, but it's consistent. For investors who focus on discipline, cash generation, and asset-heavy businesses with real products, Olin could deserve a second look. But of course, this is not financial advice, just a framework to help you think. At Insightful Value, we decode complex companies like Olin to help you see past the noise. We offer in-depth analysis of undervalued stocks, breaking down the data in simple terms to help investors at every level make smarter decisions. Visit insightfulvalue.com to explore more names flying under the radar. And don't forget to subscribe to the channel and check out insightfulvalue.com for more analysis like this.